Okay, hello everyone. Good afternoon, good evening, good morning, wherever you are. It's 2 o'clock Mountain Time here in Calgary, and it's my pleasure to have Romeo with us. Thanks everyone for joining, and this session, I believe, is going to really, you know, open up a lot of things, and we'll see benefits. So in this session, we're talking to real people that have have real life experiences. So without further ado, because of our time, hopefully we don't want this to get too long. We'll get started. And so Romeo will start up with his presentations, and hopefully that will take us probably 40-45 minutes. Then we'll have about maybe 10 minutes of questions, 10-15 minutes of questions, and we'll round it up. So we are looking at the benefits of life insurance, a real life, story, real life example. And it's my pleasure and honor to have Romeo here. I'll leave Romeo to give us a full introduction of himself, or what he does, and all of that. So over to you, Romeo. Thanks for
Thank you
coming.
so much, Demi. Appreciate it. Thanks for having me here. So I'm just going to share my screen here. Can you guys see my screen?
Yes,
All
yes.
right. Okay, awesome. So thank you so much for having me here. My name is Romeo, and I'm the Regional Sales Managing Director of Equitable Life. A little bit about my background. I grew up in Zimbabwe, and then I came to Canada, young age, and then I did my undergrad in finance and data intelligence. So I've had the privilege to work in investment banking, the Bank of Canada, and then switched off into car insurance. Then I moved on to life insurance division, and it's been a great journey. So bit about my job, right? I'm in charge of roughly 30 branches here. And underneath me, there's roughly 3,000 brokers. And Demi is one of the top brokers that we work with here. So it's always an honor and a privilege to come and just explain the different things that we do here at Equitable Life. Now, we specialize in, whole life, universal life term, and critical illness. And we also have a big national investment division that focuses on things like segregated funds, things like investments, TFSAs, RSPs, and things of that nature. But today, our main focus is showing you how life insurance is something that's really key and how the wealth building factor out of it is something that's really, really attractive. Now, at Equitable Life, we've been around since 1920 and we're celebrating our 100th year anniversary. We've got a dedicated team here in WFG, sorry, dedicated team in Equitable Life that really helps the World Financial Group brokers to be giving different solutions to clients. Now, we're representing Equitable Life, which is one of the largest mutual companies. So, what a mutual company is, it's not private and it's not public. It actually falls right in between where every single participating owner becomes a shareholder of the corporation. And that's something that's really key, especially on the strategy that I set up for myself, how I benefited from it, and how even other clients, such as you or people that you might refer, may benefit from this. Now, as you guys know, or maybe you guys don't know now, but I'm actually born and raised in Zimbabwe. So we gained our independence roughly in the 1980s, give and take, and we had a very strong economy, all the way until early 2000s. Now things started to go a little bit south, where we started having $1,000 bill, 50,000 bill, $100,000 bill, and it went so bad to a point we even had $100 trillion bill. Like I remember, even my mom would give me like $100 trillion bills just to go and buy bubble gum, literally. So things got so bad that my parents packed their bags and came here to Canada. Now, the first thing that they did is obviously set us up and things of that nature. But then I remember the next year, a handsome gentleman, he comes at home, he's looking sharp, he's in a suit. And I'm asking my mom, like, what are we gonna do? Like, are we selling our house to get another one? She's like, no, Romeo, we're getting you a life insurance. So I got scared. I'm like, is there something that's wrong with me? She's like, no, this is the way that people build wealth and it's got cash value and things of that nature. But obviously, I didn't understand what she was talking about. Now, fast forward, I grew up in Montreal. So in Montreal, we had to go to college first and afterwards go to university. So college, I was working on weekends, so I was able to manage that. But when university came, right, the stress of internships, the stress of working, but also the stress of, performing and all those things, I couldn't manage, working full time and also going to university full time. Now, I sat down with my parents and said, hey, I got into finance. I really need you guys to help me out financially. They said, no problem, Romeo. We have that covered already. And what they've done is through that life insurance, they had what's called a whole life policy, which generates dividends and cash value. So the cash value had grown. So literally for those last 4 years of university, I was using my cash value to pay for my school fees. And then afterwards, a year later, after I finished school, I wanted to move out to start my own journey. So instead of me going out to rent an apartment, because I had money in my policy, I took it out as a big down payment on top of a little bit that I had saved and became a small little owner. So, ladies and gentlemen, I'm only 27 years old and I finished school 2 years ago, but I managed to finish school debt free. And now I'm a small little home owner because of a small little policy that my parents put in place that is a whole life. So, it's fortunate that I'm actually in this industry now and I actually get to explain different brokers how you can structure this. So, if you guys have any questions, feel free to ask me and I'll be more than happy to clarify. Now, what drives this policy? What makes it so attractive? Is because when you invest into a participating whole life, what we do is that we take those premiums and we reinvest them for you to give you a bigger participating account, and we just factor out anything like taxes, lapses, and mortality, and we give back the dividends that we've been giving every single year. Now we say dividends are not guaranteed, but we've been paying them since 1936 because we've been around for the last 100 years. So we diversify into things like equities, bonds, real estate, and even things like the Highway 407, like private placements, where we make sure that we always giving back to the clients and making sure that dividend is very competitive. Now, how risky is the dividend scale that really drives, right, the whole life policy and makes people have this extra cash? So we measure this in standard deviation, which is called risk. So risk is only 1.2%, and if you see the average over the last few years of 25 years, it's almost 8% return. Now, if somebody had only had to invest only into the stock market without managing or diversifying, the risk is a little bit higher, but the returns are almost the same. Now, ladies and gentlemen, I designed this presentation called Securing Your Future's Child in All Ways, which shows you why it's so important to diversify and invest into things. Because I always ask myself, what is certain in life? Well, certain in life is that things are going to change, right? If things are going to change, we have to make sure that we have to start early in investing to things that are stable, that are flexible, that allows us to increase opportunities for our kids, for ourselves, allowing us to maintain and keep that wealth going into the family. Now, whenever we sit down, right, and think about what do we want to achieve in life, right? We always want to make sure that we have the right amount of protection. We've got something set aside for any debt, something set aside for as an emergency, and also something that's set aside as an investment. With the participating whole life, you get to have that protection. The cash value comes to reduce your debt and acts as an emergency fund, and it's an investment because you could use it for whatever you want. Now, as I mentioned with the Equimax Whole Life Wealth account, it's been around for the last 85 years and has never missed a single dividend payment, which really drives the cash value. And no matter how bad the economy can be, right, you can never have a negative return. We guarantee you that. Now, we give you full access into accessing the how to withdraw the money, how to take out loans, how to even do benefit payouts. It gives you that full flexibility because it comes with a nice guaranteed cash value and a buffer that you can use. Now, that handsome gentleman that came to my house, right, he showed my mom a simple strategy, which is using money that is not hers, right? In other words, the child tax benefit. Now, I remember about 15 years ago, I was getting roughly $300 a month. So this gentleman showed my mom that you can take even $100 and be saving it and watch how it's going to compound. Now, that was 15 years ago. And I was actually talking to a lady last month, and she said that now, 15 years later, right, she's getting roughly $600 a month per kid. So instead of taking everything and blowing it on Michael Jordan shoes, she can start saving a little bit, right, for the kid. But is that the only way that this policy can be set up to make sure that the kids are financially saving? A lot of parents have money even sitting around in accounts that are not growing, right? And this can be a way for them to package it, make sure that the money is growing, and I'll be showing you how that works. Also, we have tax refunds that we have every single year that the people can use, right? And also, grandparents always want to leave an inheritance, and this can be a way for them to even save a little bit for the kid. So we'll take an assumption of Jasmine, right? A new baby born or 1 year old. The parents wants to save anywhere from $25 maybe to 150 for the next 10 or 15 years. It's really up to them. Now, the immediate benefit is the coverage, but there's also extra stuff that comes with the policy as well. So it comes with a guaranteed payment yearly. It comes with a guaranteed cash value. It comes with a guaranteed life protection that's built inside. And through that, those dividends that I've been showing you guys drive the policy so that you have full access to the cash value even from day number one until the very end. And if anything happens to the family, they'll still have anything that combines the built-in protection, the cash value, and the dividends, and still have something left behind. Now, I'll be showing you guys why the dividends and the cash value is something that you should use, right? And really, really benefit from it. And I've designed a few strategies for you to show you how you can access that. So I'll be showing you guys high level how to even pull out the money, how to even plan for education, how to even plan for retirement, and also combine different strategies out of those to make them and call it your lifetime bank account. Now, what's the first strategy that we're looking at? Where we like to position or a plan that we like to set up for kids. This is called the return of premium plan. So how does that work? So in this case, the parent is saving for the kid. It can be anything that they want, 10, 15, $20. It's really up to them, right? Now they're saving this policy and they're, investing for the next 20 years or even 10 years or 5 years. It really is really up to them that they want. Now, the way to optimize the strategy is we set it up for you so that you invest for 20 years. And then after that, after 20 years, you just let the policy grow even more up to year 25. And then what you can do even after as a parent is if you want, you can pull out every single dollar that you put into the policy, right? And does it only stop there? Absolutely not. The dividends continue forever. You've got your guaranteed cash value that's still compounding. And if anything happens, the family still has their protection that's in place to leave for the next generation, right? So in one plan, you have a nice guaranteed portion, a nice simple savings plan, forever compounding dividends, forever compounding cash value. And if anything happens, the family is still leaving an inheritance. So this is called return of premium. Whatever you've saved into the policy, you take back the premium and make sure that you're very well protected if anything happens. Now, this is the second strategy that is actually the top selling strategy that people like to do is saying, okay, I like this Equimax plan, this Wealth account, but I already have an RSP for my kids. So how can this complement it or how can I diversify my savings for my kids or for myself? So we're looking at the same example, right? Where here you have, for example, a plan that the parent has, which is called an RSP. Now let's dive a little bit deep on what is exactly an RSP. RSP, by the way, I'm do a disclaimer, it's a very good program. I'm not saying that we should stop doing it. It's an excellent program, but there's always something that is always good out there in the world that competes and matches depending on what the objective is for that family. Now, RSP stands for Registered Education Savings Plan. The big purpose of it is for it to be used for what? For education, right? So in simple terms, what happens is that if you maximize your RSP, you're gonna put some money, Justin Trudeau is gonna match it, right? You save, Justin Trudeau matches it, you save, he matches it, you save, he matches it, up until what? Maybe you're 18 or stuff like that. But the main purpose of the RSP is for kids to go to school. But if the kid does not go to school like is planned, right? Maybe they're going to be the next Elon Musk and decide to do their own venture. But what's going to happen if you have an RSP is that all this matching that Shooter has been doing, he's going to take it back and just give you back the principal that you've had. So let's see how, with the Equimax Wealth account here, how do we make sure that this doesn't happen, but still reach those objectives or those milestones of making sure that the kid goes to school and has excess funds to use for other things as well. So in this case, what do we have? We have the same plan where we're saving in the wealth account, right? Let's say the kid turns 17, 18, they're going to university. Boom, they've got some money waiting for them there, right? Does it only stop there like an RSP? Absolutely not, right? The dividends keep driving the policy because I showed you how we're investing for you. And then that gives the client or the individual more cash value that they can access if they want. Let's say they never even touch this after university and say, you know what, this is going to be my retirement plan. No problem. You stopped paying a long time ago. Now you have what? A nice retirement plan in place that you can use for whatever you want. Now, if anything happens, that individual or that person or that son still leaves a legacy behind to the next family. So how does this compare to an RSP, right? This has no limit, right? You can use the money for school, later on use it for a wedding, later on use it for a down payment, later on still have a nice retirement, and later on still leave something even tax-free to your next generation. And you're setting this up for actually three generations under one simple plan. So this is how the Equimax Wealth Account, right, compares to what an RSP, but this has even added benefits, a life protection, cash value, dividends that are growing, and full access to your cash value without having any limitations or any things that we do. The only thing that we ask is that, do you want your money via check, or do you want your money via e-transfer, or do you want your money via what? A policy loan. We give you the full flexibility to do so because it is your funds. Now, this is the same plan, but we're showing people saying, okay, how do you plan for retirement for your kid or even for yourself as a parent, right? So we're using the same wealth accumulator plan, but then now we're positioning in a different where you can use it even for retirement if you want. Now, how do you optimize on this? Well, assuming the same thing, right? You're saving for 20 years, you're done saving after 20 years, and then at retirement, what happens is that the kid turns age 65. So if they start want to accessing the cash value, absolutely, they could do that, and they could start pulling out the money every single year. Now, we have this thing called $1 million baby plan that people like to use. So if you had to summarize, for example, all these cash flows that you can fully access when you retire, it's almost close to like $1 million that people can even use just by simple savings. And obviously, the more you put, the better amounts that you have. The less you put, the average amounts you have as well. Now, this is the retirement plan, just showing people how in the same plan, you can fully tweak it to reach your investment objectives and make sure that the person is very well protected. Now, the question is, do you have to wait until you're 65 to start using this? Absolutely not, right? So this is actually another retirement strategy where people can even start even earlier, accessing the cash value, maybe in their 40s or 50s, and use it in small increments. And this is going to actually serve a lot of people. The family or the kid is going to serve them to maybe start a business, maybe they want a vacation. But most importantly, if you are the parent and save this for your kids, you'll be retiring soon, so they can even use that funds to take good care of you. And later on, when your kids are retiring, they still have some access funds, and they have what? The grandkids that are there, and then the grandkids that are still benefiting, all under one plan, but just designing it where we can what? Access these funds even later on in life. Now, maybe some of you were saying, Romeo, you just showed me one, two, three strategies, but can I combine these strategies into one policy? So the answer is yes, yes, and yes. So what do we call this? We call this the lifetime bank account, where if the priority is for the kid to go to school, we can design it like that. Add the wedding portion, maybe they want to start a business, retire, living, it's really up to you. Here we're just showing you ideas of how you can use these funds, right, for whatever you want. Now, you have full school, that is what the priority. We have it there for you. You have maybe a wedding, that's the priority. We can do that for you. You have maybe the down payment of the house that you want to use. We can do that for you, right? Maybe access this for different things later on for vacation, maybe this for even another thing that they want to do, and then for retirement as well. It's really, really up to the person. We don't ask you any questions. You can use it for whatever you want, and the grandkids are still taken care of. So, ladies and gentlemen, this completes my presentation in terms of showing you how starting early to save really goes a long way. So in this case, I've just shown you guys how you can even pull out the money for school, how you can plan for education, how you can plan for retirement, and how you can combine all these simple strategies into one and call it your lifetime bank account, right? And use it for different important lives in the stages of the person. Now, it's easy for kids because they're easy to qualify. As a parent, it's easy for you to start disciplining yourself, right? A small 10, 15, 20, 30, 40, $50 monthly for your kid, right? The good thing is that since you're the policy owner, as a parent, you have full access to this cash, right? Which allows you to say that you need this someday, right? They can use it as an asset for them to benefit them for different things. Now, I started off by asking you guys, right, what is certain in life? Well, certain in life is that things are going to change. So if things are going to change, we have to make sure that we're investing into things that are flexible, that are stable, that allow you to increase your value and allow you to what? Leave that wealth behind. And with the ECOMAS wealth account that I had set up for myself, it gives me the flexibility to access it for different things. Actually, you can use it for whatever you want. It's stable, right? You have that stable dividend that's compounding every year. The value is always shooting up because that's how it's designed. And then it's an easiest way to what? To leave wealth or even get a few things that I want. I'm actually on my second policy right now, just personally, because I opened one just to keep my savings as a discipline as well. So, ladies and gentlemen, the floor is yours. If you've got any questions or clarifications, please don't be shy. This is a nice approach showing you different ways and removing also that stigma that people always think, oh, it's just insurance. Oh my God. But once you know that this is a hidden germ in investments that a lot of wealthy people use, hey, you just got the recipe here. And we are a company that loves to do this and show different people how to use the strategy. So any questions or comments for me? The floor is yours.
Oh, wow. Thank you, Romeo. Really appreciate that. This is an excellent presentation. Really appreciate it. It's really mind blowing.
Thank
Um,
you.
yeah. So before
Yeah.
I'll say probably I should ask the first question. Do you remember like how much premium your parents put in for your the policy they got for you then, and was it just for you or?
Oh, it was me and my sister, right? So my mom so my sister was getting roughly $300 a month, and I was getting $300 a month, and she combined both and was saving 150 for us. So technically $75 each, right? But through the dollar cost averaging, right, and compounding, it's a lot, right, over the years. So she was saving instead of saving taking $600, she would take 150, so 75 from me from her, and just save and put it also in other things like TFSAs and all those things like that. But the ones that she saw the most benefit on was from the life insurance because it keeps compounding. That's why the premium is really a premium. And this is like the Rolls Royce of insurance. If you ask anybody in the industry, they'll tell you whole life is the Rolls Royce of insurances. Good question.
Thank you.
So
Oh,
the thing is that it's not about where you start, right? It's always about where you end. And
mm,
if you think long term, right, 10 years from now, 5 years from now, you're really going to start seeing the benefits of investing and things like that. Yeah.
okay. Thanks, Romo. We really appreciate that response.
Thank you.
Okay, I can see Abiola. Abiola wants to ask a question.
Please.
Please go
Go.
ahead, Abiola. You can unmute.
Yeah, thank you. Thank you for this presentation,
My
Romeo.
pleasure. My pleasure.
Yeah, awesome. So, actually, at this point, as a new immigrant to
Hmm.
Canada,
Yes,
you get so many options thrown at you, in
absolutely.
trying to
Yes.
create wealth,
Yes.
not only for yourself but for your generations. So
Yes.
one of them is an RESP, for your kids,
Exactly.
and okay, and that okay, so if that option is checked. I saw some interesting options here today. And because recently I've been looking at life insurance for myself.
Absolutely. You can do
Yeah,
that for yourself too for adults. Absolutely.
yeah. But some of us we have our organizations that give us life insurance.
Okay.
And I've heard because I don't really know clearly, saying I've heard some brokers tell me, hey, you need to get yours separate from your organization because that is just tied to your work. And
Hmm.
okay, and that so
Yeah,
that's an option.
mhm.
Okay.
Yeah, I've heard. Are you probably talking about Knights of Columbus, something like that?
No,
I,
no.
yeah.
You mean the broker or what are you asking? I'm not
So
sure.
you're saying you have to get it from your own church or something like that,
No, no,
like
I didn't say church. So I was
organization?
informed, I was advised that I need to get a personal whole life insurance apart from that's provided by my employer that you still need to have.
Oh yes. Oh yeah, that's a good question. So well, I'll explain to it. I'm an Equitable Life employee, right? So what they would do for me personally is they'll probably cover you what, two, three, four times your salary. But the moment that I leave Equitable, that is gone, right? I've left with nothing. So you
Exactly.
always need to have something on your own side that is compounding. So
Mhm.
yeah, absolutely. The best thing is do your own thing on your own side because that's a temporary insurance for work. As long as you're an employee there, yes, you're gonna get it. If you leave the company, you can buy it outside of the company, but they're not gonna be giving you the rates that you have as a corporation. And 9 times out of 10, it probably does not even have a cash value, right? So best thing that you can do is just get your own on the side and just start building your own wealth slowly and slowly and slowly. And I
Oh,
think you were there when I was explaining the RSP strategy because I cannot see who's there. But this is just comparing how this can be even what a nice alternative too, right? Without any limitations and things of that. Yeah, because a lot of
yeah,
parents are understanding these days that yes, school is important. I'm all for it. I went to university and I loved it, right? But it doesn't dictate me to what to be a university grad to be successful in life, right? This can be used for other things, including university too, and later on than just only tying up in an RSP, for example.
yeah, you're definitely right. So I mean, I think I've not yet asked my question,
Mm,
So, but where I was actually trying to tie it,
yes.
to my question. So that was like a background. And for some of us who are much older, some of us are rated. So we have, so it means our premium whenever insurance is going to come is going to be higher. And so when you
Mm.
mentioned that, why even think of, so why look for a whole life insurance for yourself? Why don't you just target the kids once and for all? And, so that's something that kind of interested me that
Yeah,
the kids wouldn't have any issue and it should be easy for them to qualify.
exactly. Yes. Yes.
Yeah. So this is where I'm going to. So what is your so this is now my question. My question is that, so as someone who's in an insurance,
Yeah, for
broker
sure.
or in this
Mm-mm-mm.
position,
Yeah.
for a parent who, like I said, my is rated, meaning my premiums will be higher. And so is it better to go for the kids
So
rather
what parents
than
do
the parents?
actually, that's a good thing. What actually parents do, since they understand the value of this, right? So what they do actually is that parents get a small whole life, because a small whole life costs nothing, and they put a term insurance. Let's say you have assets of maybe $500,000 mortgage, right? You're gonna you buy a small whole life, and we do what's called layering. We're gonna put a term maybe for 30 years, meaning that for now until you're 77 or 85, right? For example, you have that term insurance coverage, which is gonna cost you nothing. Then the kids are the priority, right? You're gonna fund it for the kids. And when you're done funding it for the kids, you can even later on convert a little bit of your term into permanent slowly, right? And the good thing about that is that even later on, right, there's no underwriting, there's no medical, you're guaranteed to get converted to a smaller amount of guaranteed and still build cash value. So you still need to have a little bit of insurance, right? Maybe for you as a parent, might cost maybe 40, $50, right? But then at least you know you have your $1 million term coverage until your age 85 or 65, whatever, depending on your age and what term you take. But you fund and take care of the kids first. When the kids are left, then you can even start taking that allocation that you're putting on the kids and start investing in your own self, because as you're channeling that, you're still going to have some high growth in your cash and later on when you retire, you can start pulling out the money for yourself as well. So that's what most parents do, to not get a big premium on themselves and big premium on the kids. It's just not sustainable, right? So they focus on the kids, get themselves a small permanent with the term to cover them for the first 20, 30 years or until they're 85, but make sure that the kids are taken care of. And when the kids are out of the picture, then they allocate a little bit more money towards themselves in their permanent, right, to grow more and things like that, which is a cool strategy that people do. So if you want, for example, I don't know if you're licensed, but if you want like a one-on-one session for your own family, we can even book a meeting and explain how we can do that, and how, let's say you have $200 budget for the family, how we can put maybe $50 with a combination of permanent and term, and then the 150 put it towards the kids and maximize their investments. So we've play with it for you guys. But yeah,
Yeah.
I don't know if I over answered
Yeah.
your question,
So
but I gave you sort of
no,
how we
no,
like to do it. Yeah.
no. I mean, this is very interesting to
Mhm.
me.
Yeah.
Because some of what I want to say, maybe I probably should not be saying it.
Oh no, for sure.
Because
Be sure.
I was speaking to a broker,
Yes.
during this
Mhm.
week, and she was giving me options, and the options she was offering me for my whole life was
Right.
going to as much as $300 a month. And I was like, what the
Yeah.
hell?
Yeah.
I mean, how is this sustainable? Like,
It's not. It's not.
you
It's
understand?
too expensive. It's too
Yeah. So
expensive.
maybe I will reach out to Remy, and
For sure.
I
Absolutely.
will take it further from there. So thank you so much.
No, you're welcome. You're welcome. So
Yeah.
our approach, even at Equitable, how we've sustained ourselves, is that we always either work with your budget and also work with the coverage that you need. And we always look at a holistic approach. What is priority? The kids or the dad or the mom, sorry, and the family. The kids most likely will be the priority. We structure it where the kids get the maximum benefit, but the parents do have that $1 million, $500,000 coverage for the next 20, 30 years, right? And when the kids are taken care of, then we'll start allocating the funds that we're putting for the kids towards your own self for your own retirement and things like that. Because now your small permanent that you started with the layering has grown, and you can even add on top of that permanent for even more money for your own self. So it's all about planning it, right? Than just showing big premiums.
Okay, thanks, Romeo. I think we have Suleiman.
Yeah,
Uh, Hello, Mr. Suleiman. Please, you may ask your question.
yeah, don't be shy.
Yes, sir.
Hi.
Anytime.
Yeah, yeah. I think some of the question has been
Yeah.
asked already, like
Yeah.
um, the contribution like that
Mm,
your parents made when they were starting. So I think that one is already
yes.
answered. And so now my question is like, for me, I have older kids, so
Yes.
I don't know if it's not older, maybe 17, 18.
Oh yeah.
So
Okay.
we already invested in all these bank mutual funds,
Right.
and they keep on going up and down all the time. So,
Yes.
and I'm not sure, just like you said, in a situation they are not going to be using it.
Hmm.
So yeah, getting it out might be a problem. But but this option that you mentioned,
Yeah.
so that means they are not going to be receiving any money from the government, right? So I mean the portion, the RESP
Yeah.
is it
Exactly. Yeah. The
okay?
RSP portion.
Yeah, okay. So I'm not going to dwell much about on the kids because so for let's say for the adult, right?
Yes.
So it's going to be of benefit to the adult. But my concern is I don't know the percentage that will go to the insurance and the percentage that will go to investment. So that has always been my concern.
Oh, for
I don't
sure.
like to pay. I don't like to pay for insurance that much.
Yes. No, that is an excellent question. That is an excellent question. So actually, if you don't mind, right, I'm just gonna pull out something for you here. Let me take out, for example, an illustration, just high level. Okay, let's say we did really design this for you guys to make sure that you guys understand. So I'm just gonna do a simple example with somebody that has probably like $100 or $200, right? Simple for an adult. Let's say we take a male, I already have something here. Male, 34 years old, right? Comes to us and says, okay, I just want a little bit of coverage. I don't
Oh,
know.
so sorry to cut you short.
No problem.
Can you bring up the age a little bit?
For sure. Yeah, yeah. Yeah, I can put up the age for you. Or what do you want me to put it at if you don't mind?
Say let's try 45 or so.
45. Okay, no problem. So let's say here we have, let's say, a 45-year-old male, right? Just wants to pay for their policy, but then they want to allocate more money towards what? Towards the investment. So I'll just give you a brief example, right? You have here, for example, $200. Okay. So what we're going to do out of the $200, right? We'll split it into two parts. I'll show you this. So the first part that we do for you is that we take to $82 to service and come with the guarantees cash and the dividends and all those things. And then the other 117, so 82 plus 117 makes 200, right? Is entirely going towards your investment. And this investment, you can reduce it to even $10 a month to make it $92. Or if you have extra funds, you can even aggressively fund it as well. So we know people don't really like to have too much on the insurance side, but they want to allocate more money towards the investment. So we give you that flexibility. And if you want, for example, more room, right? We can even tweak it. This is just the way we design it. We can even tweak it so that you have even a little bit way more money towards your thing, towards your investment. Let's say same $200, we can even allocate it for you to have even more money towards your investment. So we design it like that for you. Absolutely. So everything is personalized here. That's our approach, and we also give you flexibility to be overfunding it beyond $89 to be more or less, and really, really up to you. So the procedure that we do here is that, for example, if you're to book a meeting with Demi, he would do what's called a financial need analysis, right? FNA. So you understand, okay, what are you ready to save a month? What are you ready to, how much coverage do you need at the end? Or maybe by the time you're 65, you probably need maybe $50,000, right? So he would design it where you put money, allocate more towards the cash. That way at 65, you have your objective and things like that. So it's all about personalizing it. And that concern comes up often, and we have a solution to allocate more money towards the investment and give you flexibility to be overfunding it and underfunding it. That's a good question there.
Oh, thank you, Romeo. Wow, that's really
Yeah,
interesting. Yeah.
yeah.
Okay, so I guess we might be wrapping it up now.
Uh-huh.
Yeah. I don't know if there are any more questions before we wrap it up. But I really want to appreciate you. So I just wanted to share a few last thoughts.
I think
Okay,
Abiola has a
it
question.
seems Abiola has a question again. Okay, Abiola, please go for it. Go for it. You can unmute yourself.
Okay, yeah, thank you. I will be following up with you, Demi, but I just want to confirm that when all the options you showed us for the kids today, what are they? I know you showed us the benefits, but are they life insurance? Because I'm seeing dividends, I'm seeing you could dip in your hand and sometime in life, maybe for wedding. So I just wanted to clearly understand: is this what is called life insurance also, or is different? Because what I know, growing up, life insurance is when you die. Is what
Aha.
you.
Oh, you just answered your question. I love it. Okay. So there you go. So I love your question. It's like you just answer the question and answer yourself. So life insurance is what's the typical thing that people say, right? Is you need it because you're gonna die, right? That's when we invented what's called a whole life policy that comes with the life insurance, right? But also comes with what? Comes with cash value inside. And this cash value is the dividends and the cash that you can use when you're alive. So that's the hidden thing in the financial sector, right? It's called the whole life, and it's been around since like 1762. If you're to look at, for example, the Canadian life insurance sales, 60% of people that own insurance, the ones that just want life insurance for when they pass away, they usually get term insurance for like later on. But the ones that like the investment portion with the dividends and all those things, they get what's called the whole life policy that comes with not only life insurance, but with the cash and the dividends and the guarantees and all those things. And you also have what's called a universal life that actually allows you to have the same thing, but for your cash and dividends, you're actually investing into the stock market. So you have full flexibility into that as well. So it's an extra step just beyond life insurance is for you to use it when you're alive. Like I used it for my school, for my down payment on my house, and things of that nature, because it's just beyond life insurance. And yeah, so that's the thing. That's our journey actually daily is educating people this, showing them that yes, if you want life insurance to die, maybe you might hate your family. It's okay. We'll find you something like that. But our mission here is to show you how you can build wealth and how a lot of communities that are building wealth. Like just to give you an example, not to derail, I know that when the Jewish community, whenever they buy a property, they get a life insurance, right? They buy a business, they get a life insurance, the whole life especially, right? Because it backs them up for anything that they need and they have full access to it for things like that, right? And even the Asian community, they're humongous on whole life insurance and universal life insurance because whatever they get the value of that, but then get the investment portion to be investing and accessing like that, making sure that their net worth is always doubled by whatever they invest into. So
Yeah.
it's an interesting thing.
Thank you. Just to add to what Romeo mentioned, Abiola, so here is the misconception in our community. And that's why for me, I've taken it up as, my mission. So I'm very passionate about it to educate, our community, to educate people. A whole lot of people, when they hear life insurance, the first thing that rings to their mind is death.
Mm,
No, at all. Life insurance is not about death. And it is that misconception,
mhm,
that for me, that I'm so passionate about in changing, let people be educated, let them have the right information. So life insurance is an investment vehicle, like the way you have in your portfolio, the way you have several investment vehicles, life insurance can be one of it. Is like, you have real estate,
yeah.
in your portfolio. You have, in fact, in North America, I was trying to pull out a report by the parliament and all of that. In Canada, for 2020, and I could share that report. So it's not an hidden report. There are two things that the wealthiest people in Canada invest in, use as a vehicle. Two major things.
Mhm,
One, real estate. Two, life insurance.
yeah.
And that is very similar to what Romeo mentioned. People, once they get a real estate, they get a life insurance, a permanent life insurance, not a term life insurance, a permanent life insurance to back it up. And those are the two major sources of the wealth for wealth for the wealthiest people in Canada. And this is not an information that is just on the roadside that people know. So that when people hear life insurance, they just think about death. No, it is the term insurance that is like a death claim, just pay out to beneficiary. But a life insurance is even for you as the owner of the policy. You can see how Romeo has shared his story.
Mhm,
He paid university,
yeah.
debt free. One of the major issues in North America is student loans. Sink a
Exactly.
lot of people. Sink
Yeah, yeah.
is a huge issue in North America, US and Canada. But for you to see people go through university without a student loan, in fact, it's something you should find
Mm,
out for.
yeah.
From that same policy, he got a down payment for for a property, for where he lives. What else? So what better legacy can a parent
Yeah.
give his children? So just part of it, I have some books here, and
Mhm,
I'm into reading and studying and knowing a lot. For
mhm,
example, this book is Money, Wealth, Life Insurance. You know, how the wealthy use life insurance as a tax-free personal bank to supercharge their savings. You know, I just got it on Amazon. You know, you
Oh,
could
yeah.
also, this is the secret of the
Mhm.
wealthy people in North America. This is one book. I have a couple of them, so I'll just show quite a number of them. See another one I got from same Amazon, how to safely turn your expenses into guaranteed income, a private banking system for Canadians. This is for Canadians. This is by Alberto Starelli. This other one is by Jake Thompson. You know, so these are what the rich people are using. I have another one here. Be the bank. How the wealthy control and compound their money and how you can too, by Darren Michelle. So you can be your own bank using, and all of these books are just talking about life insurance.
Yeah.
That's all.
There's
How
a lot.
people use life insurance
Yeah.
to change their generation, to change their own life and their generations. I have another book here.
Oh yes.
Don't, don't,
This is a
don't, don't mind me. I love reading books. I told you I'm so passionate about this topic, and I'm implementing it. Romeo just mentioned. I have my wife and I. We have 4 kids. My wife and I. We have everybody in the family has 2 policies each. So my wife and I, we have a permanent and a temporary. But for the children, 2 policies each are permanent insurance, just like what Romeo mentioned. Because there's no need for me to get a term insurance for them. We have two permanent insurance, policies. This other book, what would the Rockefellers do? How
This
the
is a
wealthy
famous
get
book.
and stay that way, and how you can too. This is by Garrett B. Godinson. All the names we hear, the Rockefellers, the Fords, name all those
Yeah.
big names. And in these books, they talked about, all these. I know a lot of us listen to Dave Ramsey and all of that. Buy 10, invest the difference. There is nothing wrong with that, depending on your situation. However, this is what I would like to state. It's a strategy Dave Ramsey talks about. For me, yes, that is it. But who is he talking to? And what generation is he talking to? People now are building portfolios. People are huge, massive portfolios in insurance, in real estate, in mutual funds, in stocks, in cryptocurrency, in so many, huge, massive portfolios. The kind of people Dave Ramsey is talking to are people that are on almost, their masses on almost, minimum wage. People that you just be talking about, okay, just say, I'm not saying anything wrong on that, but these are people that they just want to stay in a secured point. They don't want to do any, they don't think large. A lot of people now think of, how do I increase my cash flow, not on what I have, I should just live by it. The reasoning, the way people think now is, let me expand my cash flow, have several sources of income, so that I can enjoy my lifestyle, I can invest and do other things. But Dave Ramsey is just talking to people that you just want to stay in a secure position, you don't want to do anything, and you are not thinking, you just want to remain there. But I believe the people in our community, we are not like that. We are not people that you just want to stay in a secure point. You don't want to go out. You don't want to, because outside there are lions there, there are tigers there that will swallow me. So you don't want to go for a kill outside. No, those are the kind of people Dave Ramsey is talking to. People that just want a secure haven. You don't want to do anything extra. You just want to, a $1 increase to your salary is a big, huge difference for you. Those are the people Dave Ramsey is talking about. People that $1 increase, 50-cent increase, they go for celebration. They go and celebrate and invite friends. They've increased my salary with $1. Those are the people Dave Ramsey is talking about. He's talking to. Those are his audience. But if you're an upward mobile, individual looking at better things, looking at, expanding and doing greater things for yourself, for your generation, becoming your own bank. You don't need to be going to be owning the bank. Those are the people these kind of books are talking to,
Absolutely.
and exactly the presentation of Romeo today. So Romeo, I really appreciate
Yeah. Thank
the
you.
time. Thank you so much.
Absolutely.
Thank you everyone for joining this meeting. We'll be ending it here, and I really appreciate your coming. So until
Awesome.
next time, thank you and have a good day.
You guys take
Yeah.
care. All right.
Thank you.
Yeah, thank you. Thank you.
You're
Thank
welcome.
you.
Take care.
Bye.
Bye.
Yeah, thank you. Bye.